A lot of people, when they look at JD, they look at it as if it was a one-on-one to Alibaba and you would have to decide between the two companies. But I don't think that is completely correct. There are some heavy differences about JD's and Alibaba's focus. First of all, the second quarter results were amazing, 22% growth. However, there is differentiation there. They have different businesses. JD Retail, which is basically just the e-commerce side of a business, JD Logistics, and new businesses. One thing you gotta know, JD Logistics, they're not entirely owned by JD. It is now a public company, so you can buy shares in it. They own a majority, however, so that part of what they own basically gets put into their account. JD Logistics has improved massively, as has retail, because they're very heavily focused on China. JD Logistics is going international, but we're gonna come later to that. They're mostly supporting their China business, and that has done very well. JD has profited heavily from government subsidies, because most of our revenue comes from electronics. We can see electronics have outperformed the general merchandise massively. China has issued many subsidies for buying new devices, appliances, and JD was the most prominent player here. So they profited way more than Alibaba or Pinduoduo. But of course, what always punched out is the new business segment. It has catapulted in revenue growth, growing 198%. But at the same time, when you compare the margins, it has shrank heavily. They destroyed a lot of operating income. Now, this is a lot of different stuff, but a lot of this was food delivery. They basically just entered this business, and because they were so behind Meituan and Alibaba, they heavily subsidized this business in the tunes of billions of dollars. In fact, they're starting to make their own kitchens. And this is something I'm concerned about. You can't think of this food delivery business as just like Just Eats or DoorDash that we see it here. This is more about logistics, because in China, instant retail is becoming more important. China is currently still heavily going through a price war between all these delivery platforms. They want to establish their delivery system so that they can do instant retail. Basically, you order something, and instead of one day, which is already common in most parts of China, at least in the higher tier cities, you get it delivered within 30 minutes. And they want to expand their network here. This is why they're throwing away billions. They're not throwing away billions so they can deliver you Coke more easily. No, they want you to buy your smartphone within 30 minutes. And this is currently losing heavy amounts of money. So I don't really like that they're opening their own kitchens. This is not going to benefit their e-commerce segment. This worries me because it reminds me of the old Alibaba. The Alibaba that wanted to expand into everything and now has to sell stuff at a loss. And there we come to JD Logistics. Because JD Logistics at home in China is the biggest player. Not beatable at the moment, they want to cement their position there. They own everything from last mile delivery to the warehouses, so they're basically the FedEx of China. However, when it comes to their international expansion, they're launching into Europe, they have a lot of smart warehouses here, they're launching into Saudi Arabia, other markets, and here it's a bit different. Here they're going after higher margin revenue, because here they don't own the last mile delivery. Internationally, they only operate the central warehouses. For the last mile delivery is the most unprofitable part of a business. Here they work with local companies. So basically, the international expansion doesn't cost much money. They have a lot of know-how, and when it comes to these giant smart warehouses, not a lot of people are currently setting them up. A lot of the knowledge is not in the companies like DHL, FedEx, and UPS, so here they have an advantage. So this international expansion is gonna make a lot of money for very little cost. And they needed to, because the Chinese market can't grow that much anymore when it comes to logistics. They already have a giant position there. And it wasn't ever that profitable. Only recently they turned to profit, because the price war that is now going on in instant retail was happening in normal logistics before. And Alibaba and JD saw this is not sustainable, the market isn't growing anymore, we need to cooperate. They're not competing in China as much anymore, of course, they're still competing in delivery, trying to improve their logistics, but it's not the giant price war anymore. This is why they turn to profitability. Why should we compete with each other in this market, where there's not much more room to grow? Instead, we're gonna turn international. We will compete on the other front still, but this market is gonna be free for now. So I think once JD gets international revenue growth, the margins is gonna be even higher. So I'm very optimistic about JD Logistics. They really have a lot of internal knowledge that they can implement internationally, especially not when it comes to last mile delivery. Now, of course, that means they won't service everyone, but why would you want to service everyone if you can have way higher margins here? They're also slowly expanding internationally in retail, by the way. And in China, of course, they have a very great retail program because electronics, very high margin, and we can see the operating margins still growing. Now, of course, in logistics, they were slightly down. They have some investments right now that they're doing internationally, but in retail, solid margin for retail business. Now, the question about the revenue growth, we're gonna come here later, because I don't think it's gonna stay at 20% revenue growth. This is a one-time effect because of a giant government subsidies. You can see before we were growing at 1.5. I don't think it's going to be that bad, but 20%, I don't think that's going to be sustainable. Now, some international expansions they're doing, for example, they're offering to buy Seconomy, a German retailer when it comes to electronics, which is very heavily in brick and mortar. They own Saturn and MediaMarkt. If you're German, they also operate in some other European companies. You know them. They're everywhere. They're basically the electronics store. If you ask people what electronics store you don't know, they're most likely going to say one of them. Sometimes they don't even know they're from the same company. Now, they're buying them for 4.6 euros per share. That is not a lot of money for JD. That is around 2.3. Currently, it's trading at 4.4 euros a share. So it's not a heavy investment. But then the question is, why is JD trying to buy this company? This is a brick and mortar retailer who hasn't grown in 10 years. Because just like everywhere else in the world, other e-commerce players have competed with them. They cannot compete on price anymore. They have expensive giant stores in great areas of the cities with a lot of employees and a lot of floor space. So what they make money on mostly is not that you buy your new iPhone there, because you know the price of an iPhone. You can see it everywhere. But what they make money on is the little things. Do you need a charger? Can you not wait until tomorrow when Amazon delivers it? Well, too bad. Gotta pay 100% more in our stores. This is how they make their money. But because of everything around the business, they only make a 1% operating margin. And then translates to basically no profit overall. The company hasn't really made consistent net income since 2017. I don't really get what they want from this company. Do they want the stores? I doubt that they want the stores because they offer no logistics to them. Do they want the e-commerce side of a business? It's not that great. They can easily build up their own one for way cheaper probably. And once again, I think this is the issue of trying to expand in too much too fast. Just like Alibaba did back then. Could it be that JD is making a very cheap buy here of some internal stuff, like the logistics part of a business here, but at the same time, you're buying into a business with a lot of debt. So, of course, at JD scale, this is nothing, but it is still a hindrance of the business. So this is something I'm not sure on. JD is currently trying to breach into the international market in one go. They're not doing it slowly over the years. They're going in now. And it can work out, but it can also very much backfire. Now, they can afford to make all these losses in the new business segment, plus buying in internationally, because one, they're currently still riding on the high government subsidies, and two, like most Chinese businesses, they have a lot of net cash. However, JD is currently turning from becoming a pure China retail logistics play to a second international Alibaba or Pinduoduo. And that can work out, of course, where the global market is big enough for them all. Only Amazon has to worry basically there. But is it worth it? They have decent margins at home. Of course, with logistics, I can completely understand going international there. Why try to force yourself to become international? Go where it makes sense when it comes to the margins. But they're currently throwing money at the wall and hoping it sticks in some segment. And that, of course, half net income, plus all these other investments. So in some parts, I like JD. No one can beat the logistics in China. Great pure play on China, but they're currently doing a lot of stuff which I don't like. They're doing a lot of mistakes which Alibaba did, and Alibaba had to pay heavy for those mistakes. So, of course, this could work out. Of course, it could turn out completely different like Alibaba. But I'm concerned. They could have just increased their share buyback program way more. And because of this price war, JD's operating cash flow has continuously decreased. Their free cash flow has basically evaporated. So they're not increasing their share buyback program anymore. And they're also not very much increasing their dividend. Now, of course, you get a 3% dividend plus a 4% share buyback. So around 7% already there. So it is not a bad buy at all. We can see that. It's a growing business. Even if it throws a lot of money into the gutters, we get 7% from what's left over, plus the internal net income growth. Now, then, of course, becomes the question, where's free cash flow going to return to? Because it is not going to stay at these levels. It's way too low for that. Let's go with 3 scenarios. 1, it returns to around 20 billion yuan. That is minus stock-based compensation at the moment. That would be the bad scenario. Basically, it returns to pre-growth eras. 2, it returns to around 40 billion yuan. So it doesn't reach the complete height, but they go back to profitability massively. And 3, this would be the very great scenario. They return back to around 55 billion free cash flow. No stock-based compensation factored in there because it would have grown a bit since then. And the normal one, with our assumption, we would be at $3.75 per share. I'm just going to assume that they're going to pay around 30% of free cash flow out as dividends with a little little deduction due to taxes. That would enable them to acquire other businesses and also buy back a lot of shares, something which they are keen on doing. So I think that is a healthy estimate. Whatever growth it's gonna be, their retail business is not gonna grow at 20% forever. I assume it's probably gonna grow at around 8%. That is including the international expansion. They just can't grow that fast in China forever, but they're also not gonna grow at 1%. However, I think logistics is gonna add huge high margin revenue there. That plus around 3 to 5% in buybacks per year, you can easily get to 13% growth, slight slowdown afterwards. 60 multiple might seem a bit low, but it is a Chinese stock. We all know how the market values those. There we would come to $78 per share. That is a huge upside to today. So under these assumptions, JD is a huge upside. And this doesn't factor in the net cash they have sitting on the balance sheet right now. Now, what if it goes to our best scenario, where they basically return to their old free cash flow? That, plus a bit higher growth, just the international expansion works out, the internal market keeps growing more, plus an 80 multiple, then we're already at $145 a share. So you just see that there's a huge upside here. Now, what about the downside? Basically, free cash flow goes back to very low levels, and the growth levels are very low, 9 to 8%. If you exclude the share buybacks from this basically means no revenue growth. Just a tiny bit, plus here also a lower dividend payout is included, and only a 12 multiple. Here we have a 33% downside. Overall, I like JD, but I'm concerned with how they're currently allocating money. So I might start a small position in JD, in addition to my Alibaba position, but I like Alibaba's position in the cloud market a bit more. However, JD is more of a logistics play here. I might add it as a small position. Only the capital allocations lately are kind of reminding me of the old Alibaba times. What do you think? Write down below. Have a good day.